On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. The Federal Reserve in the US meets next week, and after 3 rate cuts over the second half of last year, there's a good chance they choose to pause at this point. That would see the upper bound of the Fed funds rate, which is the US version of our official cash rate, our OCR, remain at 4.5%. With the OCR at 4.25%, the unusual situation of us having a lower policy rate than the US could persist for a bit longer. In fact, if financial markets are correct, that gap will widen significantly. The Reserve Bank is expected to cut the OCR by more than 1% over the course of this year, starting with another 50 basis point reduction next month. In contrast, markets only see 1, maybe 2 0.25% rate cuts from the Fed in 2025. There's still a lot of water to go under the bridge, but that would mean the OCR ends this year at 3.25% and the Fed funds rate is at least 3.75%. It's quite rare for us to be below the US full stop, but let alone by that much. Since the OCR came into being in 1999, it's been equal to or higher than the corresponding Fed funds rate 86% of the time. On average, the OCR has been 1.8% above its US counterpart. There are a few reasons for this, including our inflation targeting framework, the higher risk profile of a small economy that's very reliant on agriculture, as well as a persistent current account deficit. We've also had high external debt for some time, and that means we often need higher interest rates to attract that capital from offshore. Aside from these past few months, the only times we've had a lower policy rate than the United States were in late 1999 and early 2000, then again from mid-2018 until the start of the COVID pandemic in 2020. One outcome of this recent uniqueness has been a much weaker currency. We've been sitting around US 56 cents against the greenback in recent weeks, which is some 15% below the long-term average of US 66 cents. That's also the lowest we've seen since 2009, when we were in the depths of the GFC, and prices for our largest commodity export, which is dairy, were in the midst of a 65% crash. Things aren't quite that dire today, although our economic situation does pale in comparison to that of the US. The US recession that many had been expecting just hasn't eventuated, and the economy still looks pretty solid. US job creation has hit a 9-month high, while the unemployment rate unexpectedly fell last month. There's also the threat of another wave of inflation, as we sit and wait for more detail on President Trump's tariff plans. All of that has seen hopes for more extensive Federal Reserve rate cuts dry up, pushing the greenback higher and also seeing longer-term interest rates rise. The US 10-year bond yield, which drives the price of fixed-rate mortgages in the US, has increased by close to 100 basis points since the Federal Reserve's first rate cut back in September. Remember that central banks are in control of short-term interest rates, but longer-term rates tend to march to the beat of their own drum, and they are more likely to reflect market expectations for growth and inflation. In recent weeks, the US 10-year yield has come close to the 16-year high of 5% that it briefly touched in 2023. It's hard to say how long this dynamic will persist across currency markets and interest rate markets, but in theory, it should be somewhat self-regulating. The weaker New Zealand dollar should give our export sector a shot in the arm, improving its international competitiveness and boosting economic activity. The lower currency should also put upward pressure on New Zealand inflation because of the higher cost of imported goods. Those two things should make the Reserve Bank a little less inclined to slash the OCR too much further, and those interest rates that maybe don't go quite as low as they otherwise would should in turn support the currency. In the US, the strong greenback should have the opposite impact, negatively impacting multinationals because their export earnings aren't worth as much in US dollars and curbing growth slightly. More than 40% of the revenues from S&P 500 companies in aggregate come from outside the US, and for the high-flying technology sector, that proportion is even higher at 56%. The stronger the greenback is, the less those revenues are worth when they're translated back to US dollars, so a stronger US dollar can put downward pressure on earnings for many US businesses. Policy changes are still very much a wild card, but softer earnings growth and lower import costs might give the Federal Reserve a little bit more breathing space. For now, over the short term, it feels like the Kiwi dollar might find itself remaining under pressure, but looking out a little bit further, we should start to see some of these stabilising factors have an impact. That's all for today. Thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.